Oracle just sold its chip company Ampere for a nearly $3 billion gain and announced a massive shift in strategy. After years of designing their own processors, they're going chip neutral. But there's more. Their cloud infrastructure business exploded 68%, and they just signed a $523 billion backlog. Let's break down what's really happening at Oracle. In today's video, we're analyzing Oracle's fiscal 2026 second quarter results. That's the 3 months ending November 30th, 2025. We'll examine 4 key areas. First, the explosive cloud growth and what's driving it. Second, the ampere-sale and strategic pivot. Third, their financial performance, including that massive earnings beat. And fourth, what management is saying about the AI opportunity ahead. Let's dive in. Oracle's cloud business just crossed $8 billion in quarterly revenue, growing at 34%. But here's what Wall Street is really watching. Their remaining performance obligations just jumped from $97 billion to $523 billion. That's not a typo. Let's start with the top line. Total revenue reached $16.1 billion, up 14% compared to last year. Cloud revenue hit $8 billion, up 34%. That's now 50% of total revenue. Traditional software revenue declined 3% to nearly $6 billion. That's license sales plus maintenance. Hardware brought in $776 million, up 7%. And services revenue was $1.4 billion, up 7%. The story here is clear. Cloud is taking. Now let's dig into that cloud number. Infrastructure as a service revenue reached $4.1 billion, up 68% from last year. This is Oracle's fastest growing segment. Software as a service, which includes their applications like Fusion and NetSuite, grew 11% to $3.9 billion. Within SaaS, Fusion Cloud ERP grew 18% to $1.1 billion, and NetSuite grew 13% to $1 billion. The infrastructure story is all about AI workloads. Management highlighted, here's the number that shocked Wall Street. Oracle's remaining performance obligations jumped from $97 billion last quarter to $523 billion. That's 438% growth. This represents contracted but not yet recognized revenue. Let me explain what this means. Remaining performance obligations, or RPO, represents the total value of signed contracts that haven't been delivered yet. It increased by $68 billion in just one quarter. That's 15% sequential growth. This is driven by long-term cloud infrastructure contracts. When companies like Meta or NVIDIA sign up for Oracle's cloud, they're committing to multi-year deals worth billions. This backlog gives Oracle incredible revenue visibility. It also shows that demand for Oracle just exited the chip design business. They sold their stake in Ampere Computing for a $2.7 billion gain. But this wasn't about the money. It was a strategic pivot that Larry Ellison himself explained. Here's what Chairman Larry Ellison said. Oracle no longer thinks it's strategic to design and manufacture their own chips. Instead, they're adopting chip neutrality, working with all CPU and GPU suppliers. They'll continue buying the latest GPUs from NVIDIA, but they need to deploy whatever chips customers want. Ellison said there will be major changes in AI technology over the next few years, and Oracle must stay agile. This is a big shift. Oracle spent years developing Ampere processors for their cloud. Oracle's earnings per share jumped 91% to $2.10. But strip out that Ampere gain and non-GAAP earnings still grew 54%. The cloud expansion is dropping straight to the bottom line. Let's look at operating margins. GAAP operating income was $4.7 billion with a 29% margin. Non-GAAP operating income reached $6.7 billion, up 10% with a 42% margin. The non-GAAP adjustments exclude stock compensation of $1.2 billion, amortization of $400 million, and restructuring costs of $400 million. What's notable here is that operating margins are under pressure. Cloud and software operating expenses. This brings us to cash flow. Operating cash flow over the last 12 months was $22.3 billion, up 10%, but capital expenditures exploded. In just the first half of fiscal 2026, Oracle spent over $20 billion on CapEx. That's more than triple the prior year. Free cash flow is now negative $13 billion on a trailing basis. Oracle is burning cash to build data centers. They're prioritizing growth over near-term cash generation. The bet is that these investments will... Oracle's fastest-growing business isn't their own cloud. It's their multi-cloud database service running inside Amazon, Google, and Microsoft clouds. This business grew over 800% in the quarter. CEO Clay Magouyrk explained Oracle's cloud neutrality strategy. Oracle has over 211 live and planned regions worldwide, more than any competitor. But they're also building 72 Oracle multi-cloud data centers embedded inside Amazon Web Services, Google Cloud, and Microsoft Azure. They're more than halfway done with this build-out. The philosophy is simple. Customers should run Oracle databases wherever they want. If a customer is committed to AWS, Oracle will run there. CEO Mike Sicilia outlined Oracle's AI vision. He said AI training and selling AI models are big businesses, but there's an even larger opportunity: embedding AI into products. Oracle is uniquely positioned to embed AI across 3 layers. First, their cloud data center software with autonomous database and autonomous Linux. Second, their database and analytics platforms. And third, their application software for ERP, HR, and industry-specific solutions. Let me summarize the 5 key points. First, cloud infrastructure revenue grew 68% driven by AI workloads from hyperscale customers. Second, remaining performance obligations hit $523 billion, showing massive future revenue locked in. Third, Oracle sold Ampere and shifted to chip neutrality, prioritizing customer choice over vertical integration. Fourth, the company is investing heavily with over $20 billion in CapEx in 6 months, resulting in negative free cash. That's it for Oracle's fiscal second quarter 2026 analysis. If you found this breakdown helpful, please hit the subscribe button and turn on notifications for more quarterly earnings analysis. And remember, this material is for educational purposes only and does not constitute investment advice. Investing in stocks carries the risk of capital loss. Always consult with a financial advisor before making any investment decisions. Thanks for watching.